In the early 2000s, the global economy seemed honestly unstoppable. Wall Street was booming, housing prices were rising, and credit was flowing like water. But, beneath the surface, a time bomb was ticking, a chain reaction that would lead to one of the worst financial crises in history. After the dot-com bust and 9/11, the US government slashed interest rates to just 1%. That meant investors were getting next to nothing on safe assets like treasury bonds. Meanwhile, countries like China and Japan were pouring money into global markets. Credit was cheap, really cheap. Wall Street saw an opportunity. Banks started borrowing massive amounts of money to make even bigger bets. It's called leverage, using borrowed cash to amplify profits, and at the time, it worked. Families were buying homes, banks gave them mortgages, but instead of holding on to those loans, banks sold them to investment firms. Those firms bundled thousands of mortgages together into packages called CDOs, collateralized debt obligations. These CDOs were sliced into parts, the safe part, the okay part, and the risky part. The safest slice got stamped with a AAA rating, top tier. Investors loved them. They seemed safe and honestly paid better than government bonds. To sweeten the deal, banks even bought credit default swaps, basically insurance, making those AAA slices look even safer. Investors wanted more of these high-yield CDOs, but to make them, banks needed more mortgages. The problem? Everyone who could qualify for a loan already had one. So lenders got creative and, reckless. They started offering loans to people with no down payment, no income verification, and sometimes, honestly, no documents at all. These were called subprime mortgages, high risk but, profitable in the short term. Why did banks agree to this? Well, because they were offloading the risk. The moment they sold the mortgage, it became someone else's problem. Then reality hit. Homeowners began defaulting, foreclosures flooded the market, housing prices stopped rising and then crashed. Now those AA-rated CDOs were packed with worthless loans. Investors stopped buying. Banks that had borrowed billions to buy these mortgage bundles couldn't pay their debts. The whole system froze. Credit disappeared, major banks collapsed, and what started with a few bad mortgages turned into a global financial meltdown. It all began with cheap credit, complex bets, and a blind faith that housing prices would never fall. But when that illusion shattered, it exposed how deeply connected Wall Street and Main Street really are. Love this kind of deep dive into how the economy really works? Then give us a like and subscribe. There's a lot more where this came from. And tell us what would you like to hear about next.